This is actually undermining. It started with silver. I think it's going to follow through into gold. I mean, all the indications are there that it will. Uh, it's beginning to undermine the most important derivative contracts in the whole of the derivative system. Now, you may think that this is an exaggeration, but bear in mind that the banks and all the rest of it who have these positions are counterparty risk the whole way across the entire derivative landscape. So what we're seeing is the potential failure, and certainly if we don't get immediate failure, concerns that there will be a failure of derivative counterparties in the whole of that space. Now we're talking about trillions.
Something is happening right now in the global silver market that seasoned analysts say they've never witnessed in modern financial history. Not during the Hunt brothers era, not during 2011, not even during the supply shock of the 2020 pandemic. December 2025 has become the moment the world finally sees the truth. The paper system that controlled silver's price for decades is breaking, fast, and the cracks are spreading through the entire precious metals architecture. Silver has officially blown past $60 an ounce, setting a new all-time high. But the shocking part isn't the price, it's what's behind the price. COMEX inventories are at multi-year lows. London vault outflows are accelerating. Shanghai is trading at a rising physical premium. And China, the single most important player in the entire supply chain, has formally banned silver exports, cutting off the last major supply relief valve to Western markets. Meanwhile, something even more alarming is happening. Open interest is collapsing while prices rise. That means this isn't speculation. It's not leveraged hype. It's not retail frenzy. It's something far more serious. Investors and institutions no longer trust paper silver. They're demanding physical metal. And that's exactly what Alasdair Macleod has been warning about for years. Today, his message has become absolutely impossible to ignore.
Basically, what's happening in silver is that all liquidity is gone. And this is in large part because the supply of silver has been less than the demand for silver for at least the last 4 years. The difference has been made up basically by drawing down on silver stocks of various sorts. If the Silver Institute puts it in its table, if you like, as investment silver. So that gets drawn down, and then they can say that, at the bottom, if you take everything into account, we've got exactly the same figure for supply as we do for demand. But the reality is that it's in deficit and has been in deficit for the last 5 or 6 years. A lot of the supply, if you like, the excess supply, hasn't been investment so much, but it's been dishoarding by China. They've been prepared to try and put a lid on the silver price by ensuring that manufacturers of things that use silver, like photovoltaic cells and things, do have access, even though China is the largest producer of photovoltaic cells itself. China has always had a very firm control over silver. Well, now what's happened is that China, first of all, has withdrawn from supplying the West. That's the first thing. And the second thing is that from January the 1st, the export of silver is banned from China. So you can see that this is creating a huge, great problem in the markets. Now, history of the derivative system. It was originally brought in and sanctioned by the US Treasury as a means of suppressing prices of commodities, particularly gold and silver, but particularly gold, by diverting demand away from bullion into paper bullion, if you like, bits of paper. And this sort of fitted in quite well with the regulatory situation which evolved in the early 1980s, whereby regulated investments were defined as stocks, shares, bonds, so on and so forth. But unregulated investments included gold, silver, and copper and other commodities. Because they were not regulated, it basically means that the compliance officers will limit what an investment manager can do in terms of investing in physical gold, physical silver, and so on and so forth. So what this meant was that there was a control on the price, particularly of gold and also silver and copper and oil and things like that, by the expansion of these derivatives soaking up demand for them without people actually bothering to get the underlying metal. And so consequently, the prices of underlying metal didn't rise. What we are seeing in the silver market now, however, is the complete loss of liquidity. There is massive dealing going on in silver derivatives. But of course, rather like a tire hitting the road, there comes a point, if you like, where people actually want the physical. And that is beginning to happen. Consequently, in London, there's nothing to deliver, even though they've been dealing in huge quantities. And the squeeze on COMEX has been evidenced, if you like, by the fact that silver's shooting into new high ground, while at the same time, open interest is declining. What the decline in open interest tells us is that the speculators are not buying it. They're not going for it at all. The price is rising not because of speculation or investors, if you like, buying it. It is rising because the system itself is close to default. There is also a shortage in Shanghai. And looking at the combined stocks of the Shanghai Gold Exchange and also the Shanghai Futures Exchange, that's fallen to around about 570 tons, which is seen as close to crisis level. 600 being, you don't want to see stocks less than 600. We're about 570. There's a little bit creeping back in. I saw overnight there's about 14 tons came in or was recorded as having come into the underlying bullion stocks. But it's still a very, very difficult situation. Now, the point about this is that the use of of derivatives to soak up demand for commodities, that story has now come to an end and it's beginning to go into reverse. Now, just imagine you have got a large number of bullion banks, hedge funds, and all the rest of it who have positions one way or the other in derivatives. And these are now questioned as to their value. As that unwinds, then the demand is going to go into the physical. So you can see that as that contract on COMEX and also forwards in London begin to collapse, and it looks like that we're in the early days of that, then this in itself, purely in terms of substitution, is going to push up the silver price very, very substantially from here. So this is the importance of what we're seeing in silver. Now, if it's true in silver, it's not far behind being true in gold. Because again, if you look at open interest on COMEX, that's collapsed, while gold has been trading close to the highest levels ever. This is an extraordinary situation. They're both becoming what have been described as giffen goods. In other words, the normal laws of supply, demand, and price have been completely suspended. Instead, what happens is that as the price rises, it creates buyers and reduces supply, which pushes the price up even further.
Yeah.
And that's what we're seeing. And this is actually undermining. It started with silver. I think it's going to follow through into gold. I mean, all the indications are there that it will. It's beginning to undermine the most important derivative contracts in the whole of the derivative system. Now, you may think that this is an exaggeration, but bear in mind that the banks and all the rest of it who have these positions are counterparty risk the whole way across the entire derivative landscape. So what we're seeing is the potential failure, and certainly if we don't get an immediate failure, concerns that there will be a failure of derivative counterparties in the whole of that space. Now we're talking about trillions of notional value affected by this. So this is another aspect, if you like, of things that just seem to be going wrong at exactly the wrong moment, if you like.
Yeah.
So that's the importance, really, of what silver is telling us, I think.
To understand what's unfolding, you have to look beneath the price charts, deep into the structural mechanics that hold the global silver and gold markets together. For 5 consecutive years, the world has been in a structural silver deficit. Global mine output has stagnated, industrial demand has soared from solar, EVs, and electronics, and investment demand has doubled. For a while, the system survived by draining inventories, quietly drawing down investment silver, and rotating the same bars through COMEX and London to maintain the appearance of stability. But the game is ending. China, long the silent stabilizer of Western supply, has withdrawn from the market. First, it reduced outbound flows, then it restricted exports. Now, in 2025, all silver exports are banned. That alone, as analysts point out, removed one of the largest liquidity sources Western markets relied on. As a result, liquidity has collapsed. The spreads are widening, premiums are rising, lease rates have spiked, refiners are delaying shipments, and global vault data shows one of the fastest metal drawdowns in decades. This is where Alasdair Macleod's warning becomes urgent. The entire derivative system, trillions in notional exposure, depends on the assumption that nobody will ever ask for real metal. But now they are. Investors who once rolled contracts are demanding delivery. Hedge funds that once used silver as a volatility hedge are exiting paper positions entirely. And sovereign entities, especially in BRICS-aligned regions, are accumulating physical metal off exchange, away from Western transparent reporting. This creates a massive pressure loop. Open interest falls, fewer paper claims. Price rises, demand increases. Physical availability drops. Confidence erodes. More investors demand metal. More demands for metal, the price breaks upward again. This is the signature behavior of what economists call a giffen good, where higher prices do not kill demand, but increase it. Macleod's core message to investors is crystal clear. You are watching the early stages of a systemic reset, where synthetic supply is failing, counterparty risk is rising, and the pricing power is shifting from paper traders to physical holders. And this is not limited to silver. Gold is showing the same stress signals. Open interest is falling even as gold trades near record highs. Delivery requests are rising, and the spread between paper and physical is widening. Add to that the macro backdrop, surging global bond yields, liquidity shocks in Japan and Europe, sovereign debt stress, currency debasement concerns, central banks quietly accumulating metal, and the financial architecture looks weaker than at any point since 2008, but with far fewer tools left to stabilize it. This is the scenario Macleod has always described, a breakdown not caused by price volatility, but by the loss of trust in the system designed to control the price.
Journalists and commentators are controlled, if you like, by the editorial, and editors have really very little interest in promoting stories about gold and silver. And I think, to be fair to editors, they're looking at their wider audience, and they're reflecting, if you like, the view of the wider audience. When it comes to individual opinions amongst journalists, I think they're equally at sea. I mean, there are some which are not. But bear in mind, it's 54 years now since gold was officially part of the monetary system. And we've had all the propaganda from America, and that does actually continue to influence people. You've also got the whole of the macroeconomic community, if you like, of economists and all the rest of it. Now, this denies the theories of sound money, which have been so well established over millennia. But it's different now, they say, and they have relegated classical economics and the importance of sound money, etc., into microeconomics. In other words, we don't bother with this little stuff, if you like. That's the way in which they try and persuade us and persuade themselves that gold is no longer part of the monetary system. The dollar is king. And they ignore the fact that currency is actually a balance sheet entry on a central bank's balance sheet. It is a liability of a central bank to the holder of the currency. And equally, bank reserves on the central bank's balance sheet are a central bank's liability to commercial banks. These are liabilities. I mean, it's not, this isn't money. I mean, as J.P. Morgan, the original John Pierpont Morgan, in evidence to Congress back in 1912, he said, gold is money, all else is credit. And he was right. It's still true today. And the idea of the debt bubble bursting, yeah, that's absolutely right. And the way in which it happens is that the purchasing power of the units in which the debt is denominated deteriorates, and in fact ends up collapsing if nothing is done about it. This was the fate of the Reichsmark in Germany between 1920 and 1923. It very often happens in sort of slight phases, but I think we're getting into a rather dangerous endgame here, which really means that when it bursts, not only does the credit bubble burst, the debt bubble burst, but it takes the credit bubble with it. So that's what happens to stocks and shares. They are sustained by this credit bubble. They will collapse with this debt bubble imploding. And at the same time, because the only way in which governments politically can respond is to try and rescue the banking system, to underwrite the entire economy, etc., etc. They've given themselves that function, if you like. The consequence is that the expansion of credit at that stage in the form of currency is just going to go through the roof. It's bound to. And so the purchasing power of the currencies, and this is the key point to understand, it's the purchasing power of those currencies which collapses. Of course, we think that, you get a hyperinflation and all the rest of it. No, that's just looking at the symptoms. Really what you've got to look at is how the purchasing power of the currency collapses. Then you can understand the process. It drives up bond yields. That was one point you made. And I noticed that the Australian 10-year bond yield has risen 0.5% in the last 6 weeks. That's it's rather leading the way along with Japan. I mean, the Japanese bond yield really soaring now, and the consequence of that is that it's undermining the carry trade, upon which the purchases of U.S. Treasury really do depend. So you've got the potential for rising bond yields triggering, if you like, a debt crisis, and I think that's probably not too far away from here. The other point that you raise is, do you believe what would be the effect on our living standards? It will be so destructive of our living standards. It will be horrid. I mean, there's no two ways about it. And the only way in which you can protect yourself from the economic destruction that the collapse of a fiat currency brings about is to hold real money, which is definitely gold. Silver less so. Silver has the traditional role of being a monetary metal. And I have absolutely no doubt that people will go into silver in increasing numbers once they begin to realize the risk that's inherent in credit. And of course, the other thing is that if you look at bond yields as a whole, they will rise and rise and rise because they reflect the risk of lending, bank lending, if you like, bank lending, or even buying bonds, whether you're going to get actually repaid at the end of the day. And furthermore, what is the value at the end of the day of a loan? If the purchasing power of the currency in which it's denominated is collapsing, then are you happy with 5%, 10%, 20%, 30%, 100%? I mean, this is the reality of what happens when you have a currency collapse, a credit collapse. And the only way out of it, really, is to ensure that you can feed yourself, and to ensure also that you are out of credit and into real money as much as you possibly can.
We're watching a historic shift. Not a rally, not a spike, not a bubble. A systemic transition from a world where silver and gold prices were dictated by derivatives to a world where prices will be dictated by real metal in real hands. So here's the key question I want to answer directly, because every viewer is thinking it. Question: could silver disconnect completely from spot and trade at much higher real-world premiums? Answer: yes. And according to Macleod, we are already seeing the early signs. When inventories fall, when delivery risk increases, and when traders exit paper for physical, the quoted spot price becomes an outdated reference. Silver begins trading at the real price, the price of scarcity. And if this continues, the gap between physical premiums and paper spot could widen so far that the two markets become effectively separate. That's the moment every serious metals investor prepares for. Before we close, here's the most important message Alasdair Macleod communicates to investors. If you don't hold physical metal during a system reset, you are holding someone else's promise, and promises do not survive systemic failure. If you want more deep, insider-level analysis on what's happening right now in gold and silver, updates the mainstream media refuses to discuss, make sure you subscribe, tap the notification bell, and stay with this channel, because the reset has already begun, and the next few months may decide everything.